In today's video, I'll be covering the very basics of the stock market, so if you're a beginner or if you could use a refresher, stick around to learn something new. So to demonstrate how the stock market works, let me give you an example using gardening. So imagine you have a home garden where you grow a whole bunch of veggies like tomatoes, corn, and beans, but you've only been consuming the produce that you've been growing yourself at home. But now you want to start selling your all-natural organic vegetables at the local farmer's market and create a real business. But in order to do this, you know that you'll need more plants, more seeds, and to rent a portion of farmland so that you can increase the amount of produce that you're growing. And this all sounds great, right? But the issue is that you know that you don't have the funds to pay for this endeavor. So instead of going to the bank and taking out a loan, you decide to split your company up into 100 different pieces or shares and sell each one of these shares for $7. And you would do this through an initial public offering or an IPO. And as people start to purchase shares for your company, then you take that money and you invest it to build up your business. As you take the money that you earn from selling shares and you grow your organic vegetable business, more people start to notice, your business becomes more and more profitable, and that would cause demand for your stock to increase and the stock price would also increase. But as we know, nothing in life is ever completely linear, so the inverse could also happen. Say if a huge frost comes and kills your entire crop, then you would have less to sell at the farmer's market, and so your profits would suffer, demand for your stock would decrease, and the stock price would also decline. And this is essentially how the stock market works. Businesses offer shares, which is partial ownership in a company, to investors. For example, there is not just one person who owns Tesla. There are thousands of shareholders who own a portion of the company. Investors can buy and sell stocks on the stock market exchange through using an online brokerage. And these days there are very many options to choose from, such as Fidelity, Vanguard, M1 Finance, and Webull, and there are others too. So to buy a stock, you would need to add funds to your online brokerage account, and then from there you would look up the ticker symbol or the company that you desire and then place an order. And once you sell your stocks, then your money comes back into your online brokerage account, and from there you can either leave it in the account because some brokerages do offer an interest rate on the money left in the account, or you could obviously choose to take that money and reinvest it into different stocks. Now let's talk about how to build wealth in the stock market. And there are two primary ways to do this. The first method is to buy a stock and hold on to it for a while in the hopes of taking advantage of capital gains. A capital gain is the profit that you earn on your investment when you sell it for more than you initially paid for it. For example, if you buy a bottle of fine wine for $1,000 and then some years later the value of that bottle goes up and it's worth now $4,000 and you choose to sell it. So your capital gain would be the difference between the purchase price of $1,000 and the price that you sold it for, $4,000. So you would have a $3,000 capital gain. And capital gains for the stock market work in the exact same manner. So you buy a stock right now in hopes that in the future the price will increase so that when you sell it, you will earn a profit. You can definitely build wealth in the stock market using this strategy. It works for many people. But it's important to keep in mind that there is no absolute guarantee that the value of the asset you purchase will increase over time. You could actually completely lose all of your money, which is why it's important to do your research on the stocks and the companies you're considering investing in prior to investing. The next strategy to build wealth in the stock market is through dividend payments. So when a company is profitable, sometimes it will pay out a portion of those profits to shareholders in the form of a dividend payment. And companies can choose to give out these dividend payments on a regular basis. Like many companies will make a payment each quarter, or sometimes that payment can be irregular. It really just depends on the company. And some companies have a high dividend yield, like Newell Brands, for example, which owns popular brands you've likely heard of, like Sharpie, Elmer's Glue, and Rubbermaid. And Newell Brands has an annual dividend yield of 7.52%. So this means that if you invested $1,000 into Newell Brands stock, then in 1 year you would earn $75.20 in dividends. And this would be split into 4 payments of $18.80 throughout the year. And this may not seem like a lot, but the more you invest, the more that these dividend payments can really add up. Dividends are great because they are completely passive income, so you don't have to do anything on your part to receive the dividends because they are distributed automatically. But you do have the choice to either take the cash payout or reinvest the dividends through DRIP, which is a dividend reinvestment plan. And what you choose to do with your dividends just really depends on your reason for investing and your financial goals. But also do keep in mind that companies are not obligated to pay out dividends, and a company could stop paying dividends at any time for any reason, especially if that company is running into financial trouble. So now you may be wondering how exactly to get started investing in the stock market. And drawing back to my analogy at the beginning of this video, just like a well-tended garden can yield huge harvests, learning how to become an informed investor in the stock market can potentially yield huge returns in the future. So building out a diversified portfolio of stocks and bonds is a great place to begin. And you can choose to invest in individual stocks, but I would also say it's worth it to consider investing in index funds and ETFs, since these investment options will diversify your money for you by divvying it up into hundreds and sometimes thousands of different stocks. I have a separate video where I talk about the similarities and differences between index funds, mutual funds, and ETFs. So if you want a deeper dive into that, the link will be in the description section below so you can check that out afterwards. But whether you choose to invest in individual stocks, index funds, ETFs, or some combination of those, I highly recommend that you spend the time to do your research and understand the company or companies that you potentially invest in. Especially if you're planning to invest with a long-term horizon, this isn't a decision you want to rush, and you want to be careful and make sure you're understanding what you're getting yourself into. If you have any questions on stock market basics, go ahead and drop a comment below. I read and respond to every single one of my comments, and I would be happy to help you. And if you like this video, give it a thumbs up so it can get boosted in the YouTube algorithm, and subscribe to my channel for weekly personal finance content. And if this video just totally pumped you up and you're ready to consider investing and you want to get started with index funds, then click the video on the screen for a step-by-step tutorial to investing in Fidelity index funds. And thank you for watching.